welcome to At the Forefront Fintech Conversations. I'm Sam Belden, head of content at Forefront Communications, and with me today are Martina Rejsjö, head of product strategy at Eventus, and Vinod Jain, strategic advisor at Datos Insights. Martina, Vinod, welcome to At the Forefront.
Thank you. Nice to be here.
Happy to have you both here today. So the reason that we're hopping on today is that Eventus recently partnered with Datos to produce a new piece of research entitled The Trade Surveillance Revolution, which includes perspectives from 20 leading banks and brokers on the challenges, priorities, solutions that these firms are facing for the critical trade surveillance function. So Eventus, of course, is a leading provider of trade surveillance solutions, and they've helped drive the direction of this research conducted by Datos Insights. Today, we're going to dive into some of the key findings in this report, and be sure to stay until the end of the episode for a few practical tips on what firms can be doing right now to start to modernize their trade surveillance function in the face of these challenges that we're going to talk about. So we'll get to all that, but let's start at the top of the story. Vinod, curious to get your take on the overall state of trade surveillance today based on your research and your thoughts on why this study felt important to undertake right now.
So thank you so much, Sam. So I think the interesting study was around the trade and market surveillance. And thank you, Eventus, for sponsoring this study. I think the best part about the study was to have detailed conversations with 20 leading global sell-side financial institutions and have a very focused study only on the trade and market surveillance portion of it, not to go into any other kind of surveillance. And I think that gives us the opportunity to really deep dive and have a detailed conversations with the respondents over here. We had approximately 45% of the respondents from the US region, followed by 35% from the EMEA, and then remaining 20% was from the APAC region. I think each discussion was approximately around 1.5 hours. So effectively, we had like 30 hours of real insights, which we received with the head of compliance, with real stories and real analysis, and the discussions which went into a detailed conversation level to really understand the strategy, ops, technology, and how the entire surveillance function works within the banks. We also believe a detailed discussions, which is also supported by an excellent interview guide. And I think those were the key reason to get a good insights in terms of the pulse of the function which is being performed, but also get a strategic view of the surveillance. So primarily the study was focused on evolving trade surveillance strategies across asset class, regions, and technical architectures, the regulatory view, and as well as the operational challenges. Absolutely, the adoptions of AI and the real-time analytics need, which we have seen it quite more prevailing now, and also the strategic initiatives which the banks are taking to develop the next generation trade surveillance capabilities.
Fantastic. Well, Vinod, thank you for the background on the methodology and some of the top-level findings from the research. Martina, I want to bring you into this discussion. From your vantage point of working with clients all around the world, what is driving these firms to rethink their approach to trade surveillance?
Yes, I think there are a couple of things, and I would say that budget concerns is the biggest driver, I think, to look over your surveillance program and see where you can enhance or get, innovative ways of getting better efficiency. I do think they get asked a lot, do more with less. I think it's a very common theme right now. So that really is a big driver in how you can enhance your surveillance program. But I think another source, and I think this is also pointed out in the report that we have, is regulatory changes and fines are a big intel into how and why you need to change your program as well. The regulatory environment is always evolving, and firms just needs to have that as a continuously review of their program to make sure that they're up to date to the changes. But also when fines come out from the regulatory agencies, I think that's a very useful read to understand how your program needs to adapt, because the statements that comes out with the fines are often very detailed on the deficiencies that has been found, but also the expectations on what you need to have as an adequate surveillance. But then lastly, also you have more organic demands that will force the review of a program. I mean, this is really when you're going into a new asset class or a new region. This is a natural step to make sure that your program is designed to handle these new and specific market structures around those areas. And, crypto asset is one example of that, but also the 24/5 trading expansions that is being talked about now are really two sort of examples on things that will trigger a review of your surveillance program.
If I could just chime in on this one, I think, as Martina mentioned, I think the surveillance remediation programs, I think this was one of the key initiatives which most of the large global sell-side banks have started. And I think the reason is it's not because the fine goes to one global bank. I think the one fine, it gives a signal across to all the institutions to initiate the remediation programs absolutely across all the regions over there. And I think that's a consistent theme which we have seen uh, across the discussions.
Makes sense. Well, thank you both for the background on some of the key drivers that are pushing firms to modernize their approach to trade surveillance. We touched on a few of the report's top line themes there, and when we think about 24/5 trading, the march towards trading globally and across asset classes. All of these things sort of magnify the data challenges that these sell side firms have been struggling with, in how that informs trade surveillance. So, Vinod, I'm curious to get your perspective on what are those key data issues that firms are grappling with as they face these higher and more complex data volumes, and why do these challenges matter so much in that surveillance process?
Absolutely. I think look at it both the sides. I think data which we saw is both the biggest challenge, but also it provides the greatest opportunity in surveillance. And I think that generally gives the overwhelming systems to say that yeah, they can empower them tomorrow if they harness it correctly all the around the data management portion of it. And I think if we look at it from our respondents, I think with 55% of the respondents, they expressed neutrality to ensure that are they receiving all the information, have they been collecting all the information with respect to conducting the surveillance, as well as the data validations and the integration mechanisms which goes along with it. And although a substantial portion of data collection is automated, the challenges lies in sequencing it effectively for processing, transformation, and surveillance readiness. And what it effectively means, the availability of the information is there. I think the challenge is in terms of ensuring that you process it, you sequence it, and ensure that the information what is required as part of the completeness is all available as such. Look at the reference data, such as the client or the securities tagging for a pre-approved post-trade compliance. It's often managed in a way, in an ad hoc manner. And I think the reference data team, they do their portion of it. But then it's left to the other groups to find out that what's the impact of a one client change or a change in the one security where it has all been changed. Similarly, look at the modifications of the reference data around it. And I think in the report, we have highlighted various specific examples of the data quality issues which we have seen, right from pricing and currencies to say that, yes, what is the base currency which is being used for an FX transactions? Because the way you book an FX transactions, you can have a major currency, minor currencies, and the trade gets booked in a different way. So there's always a kind of an inherent logic inbuilt into the systems to identify what is the firm trying to do and which currency they're trying to buy or sell in that transaction. Absolutely, I think that some of the firms have also mentioned that they were not receiving the pricing parameters as part of the sourcing of data. So they were actually going down manually to a Bloomberg terminal to validate that was the price availability of that specific security was. Looking at some of the systems integrations and processing issues that we have highlighted in terms of when the trade has been booked in any firm, there are lots of cancel correct which happens. And I think that's major aspect to ensure that like the correct information is being sourced into the trade surveillance systems. The other one which we have also seen is then the trade executions and order matching portion of it. Just to get the full order book from top to bottom is it's something that provider has to provide that information. The venues who are operating those securities, they have to be able to provide the top order book and the complete order book for the sourcing portion of it. And lastly, I think it's the large global banks, they operate across the globe. And I think one of the key challenge was the clock synchronization, which we have seen. because a small difference of couple of seconds between the various systems can really offshoot that the market history what you are going to represent and the surveillance activities what you're going to perform against that specific time frame can really offshoot. Either it can create the alert or it can remove the alert from the whole system over there. So I think in terms of the overall data aspect of it, we look at it more with respect to an opportunity than a challenge. I think it's more in terms of the governance to ensure that the data is used as a opportunity for the surveillance function to really get the next level of insights over there.
Great. Well, thanks for
I
that.
think,
Yeah, please.
yeah, if I may, Samuel, I mean, I think this is an example though where sort of a regulatory fine really put that on the roadmap for the larger banks or the participants in the market, right? Where data governance is really high on their agenda. And, much of what Vinod said, I do think it really has highlighted the need for at least having ownership of the data. Who owns the data to make sure that you can track it all through your system? Because the big thing is once you have mapped it, you'd still have to continue to review it because changes happens. And do you know what that change, how that change impacts your all the way sort of flow through your system down to the surveillance system? So I do think it is high on the agenda to have a good data governance, and it's very important to have an efficient and relevant surveillance program.
Very, very valid point, Martina. I think in terms of the data ownership, I think that's very critical because as and when we see the transformation logic getting inbuilt, the ownership doesn't stay with the system of records who has originally provided the information. And I think that's where the real challenge of the data governance portion comes in to really ensure that the lineage of the data ownership is clearly established. Even if there's a transformation, the original information still stays with the system of records.
Fantastic. Well, thank you both for the insights there. Certainly no shortage of challenges, but Vinod, as you said, opportunities at play when it comes to how to harness and make the most of data for trade surveillance. So I know that one challenge that came up a few times in the report, driven in part by high data volume and how that data is managed, is the false positives and the high number of false positives flagged by many existing trade surveillance systems. So, Martina, I want to get your perspective on this. In your experience, why are false positives so difficult to solve for, and what are maybe some practical steps that can be taken to address this challenge?
Yeah. False positive is the favorite subject of mine. And I think the next thing I will say will give you a hint to as why it's so hard to navigate. Because I don't think you should call them false positives. They are really low value alerts because they are triggered by your surveillance system, by your set parameters and thresholds. So they are in fact alerts. But then, of course, once they are triggered, you can deem them not to be of high value. And I think that's where people say, well, it didn't result in anything. It's a false positive, but it's still an alert. So you do need to have a way to handle these things in a sort of controlled manner. And I think there are a couple of ways that you can look at this dilemma on sort of the too many low value alerts or false positives. And I think, if it really truly is noise, then you definitely should calibrate your program to be more efficient and effective and reduce the number. But that involves calibrating. And the risk is always that you calibrate too much and then you miss out on potential manipulative or disruptive behavior. And that is the risk that most firms are not willing to take. So I think a better approach is actually then to what we call cast a wide net. And then you have more of an automated way to handle the low value alerts. And Eventus offers automations, which really is a data-driven analytics to systematically close out alerts. Um, and when you do that, you still have the alerts there and you have an audit trail as to why and how with the data points documented as why you closed it out. And then you will keep you keep all alerts, you escalate the high risk alerts for human review, and then you have the audit trail of everything you have done within your system. But I think that's the way to handle just the noise. But I also think if you do it this way, the really big opportunity here is that you can actually use your low value alerts or your false positives to enhance your insights into your program. Because you can, for example, do a near miss review of the alerts that has been systematically closed. You will go through them and you will find perhaps a pattern of practice. If there is an account that is always being closed out by the system, but it's triggering a lot, that should warrant sort of just a review of that pattern specifically. And you can, but then also, if the other example would be if you have a lot of alerts that are just always being closed out, then that should trigger a review of your calibration. Because again, if you deem them always to not be useful, then it is noise that you should address by calibration. But I think the key here is really to use your false positives to enhance the effectiveness of your surveillance program. And I really do think the key is use your low value alerts to get the insights into your program. So I am passionate about this subject. I think it's really, really interesting. And noise is bad, but there's a lot of insights to gain from just the bulk of the low value alerts.
I think that's a very smart approach. I like your framing of it, of sort of going beyond just setting priorities and maximizing your resources and the productivity of your team, and actually using some of this, what may seem like noise, to actually get better at trade surveillance, make your business better. So thank you for that background. I want to move on to one of the other major themes in the report, which is the use of artificial intelligence, AI, in trade surveillance. So, Vinod, I know you had many conversations on this topic. Curious to get your perspective on where firms are applying AI today, where the progress is maybe been a little bit more incremental, or where it's going to be future state, and overall thoughts that you have on the state of AI for trade surveillance.
Okay, I think a very interesting and relevant topic actually related to it. And I think in our discussions, I think every firm has embarked on a journey for the AI adoptions around it. Obviously, I think being a global bank, they would have their governance policies around it. But I think there is no questions that AI cannot be implemented in the trade surveillance space over there. I think just relaying it back to what Martina mentioned about the false positive, or the new terminology for it would be the low value alerts around it. I think looking at it, I think that's the cost of doing the compliance function, because I think you don't want to get a blindsided that suddenly your false positive rates have dropped like dramatically by 50% in the large global banks, because there's so many things around it. I think you want to ensure that you look at those low value alerts and then you slowly transition it towards the automation side. I think firms have embarked on an efficiency journey wherein they have leveraged the global operating model. I meant to say that the offshore centers or the captive centers have been used to ensure that the operations team look at the low value alerts and identify that yes, these are true low value alerts and these are the true alerts. So then that way the high alerts can be investigated further. Looking at the AI adoption portion, I think firms have embarked on that journey, and I think everybody, majority of the firms, they were saying that yes, they can reduce the automation, they can reduce the alerts by almost around say 25 to 50% by using the large AI models over there. I think interestingly, some firms have embarked on a journey and they have went live. Actually, I think there was a large investment bank which went live with the machine learning to detect a rogue trading actually for a specific desk, and they were able to reduce the false positives by almost 80%. And this was being confirmed and validated with the large global investment bank over there. I think another thing where the firms have also been able to leverage is around the commentary which needs to be associated when you identify the true value alerts over there. I think the amount of information which is required to support the documentation around case management is huge. And that's where the AI adoption can really help the compliance analysts to give them the jump start required to document the entire series of sequencing of the events, so they can focus more in terms of the analysis and in terms of highlighting the key points around the alerts over there. So I think in terms of the AI adoptions, absolutely, to reduce the false positives and the detection accuracy, firms have embarked on that journey. At the same time, the firms have also looked at trust but verify approach on the AI. They don't want to get blindsided. They want that magic to happen of AI in front of them. And I think that's the biggest learning, which I believe in the AI journey, which everybody has seen, that they want to look and feel the AI component much more than happening it in the background over there. And I think that's the view from the compliance view, that they want to see the magic happen. They want to, and that's the magic. They want to ensure that there's a trust but verify approach in that process over there.
Makes sense, and some great anecdotes there. I know that case management was definitely a pain point with legacy systems that was flagged in the report. So some good background there from you, Vinod. Martina, I want to get your perspective on AI for surveillance, and in particular, if you have any perspective on the sort of regulatory view of all of this and what firms can do to account for how regulators may be looking at AI and trade surveillance.
Absolutely. I mean, I do think AI has almost become the holy grail of efficiency within surveillance. That's the answer for a lot of ways to enhance your team's ability to handle things. But I do think there's still a way to go in the common understanding on what is acceptable and what model are you willing to use and how far do you want to take the capabilities. I do think we are at the place where we know that it's going to be used some way or another, but it's just that, like, where is that acceptable use case or the acceptable implementation of it within your program? How much do you want to automate? I think that's the debate, right? And I do think that many compliance tools that are out there today rely on probabilistic models, the deep learning and large language models. And these are all very powerful tools to recognize patterns and making predictions, but they often struggle with explainability. And I mean, that is the key. You have to be able to verify and demonstrate the output. And that is the challenge many firms are having right now. If a model highlights a transaction as suspicious, but then the decision is based on an unknown inputs rather than the clear rule set, it does raise concerns about fairness, bias, and reliability. And those are the questions regulators will have of your program. You know, what is the model? How does the model work? How can you ensure it's not getting, the training is not biased, or you just get a training from a few person that will then not evolve the AI as wholeful as you would like it to be. So there's so many consideration with that approach. And I do think then, but on the other hand, you have the deterministic AI models, and those are more designed to provide a clear and structure and most of all repeatable output. So instead of generating predictions based on past trends, the deterministic approach then retrieves a specific verifiable data point and presents that in a format that you can audit. And this approach ensures that every decision can be traced back to its underlying data and reproduces the outputs as many times as needed and to demonstrate that reliability. So it's two very different approaches, and I think the application might be in between, right? So it is really that journey, like where do you want to put yourself between these two models? I would just say that at Eventus, we have taken the approach that we will need explainability and regulatory readiness, and that is the one that should define the AI roadmap. And we do have a forthcoming AI solution that we call Frank. That is really more of the deterministic approach. We will allow analysts to ask questions about validated data and just sort of enrich the alert at their fingertips. You can really just bring in the context much easier. But we are relying on code, so we will bring back a code and they can deploy that code, get the answers, but most of all, then the code is kept and you can redo it and get the same answer again. So I really do think that is a sort of first step on having that trust that you actually can repeat and explain what the output of the AI model was.
Great.
But I really think the potential of AI to drive efficiency is very well understood at this point. I do think the future conversation will not then just focus on that, but more importantly then focus on ensuring and demonstrating accuracy and integrity. So, I really do believe that explainable AI-powered trade surveillance is the future, and people are getting there for sure.
Absolutely. I think if I
Well,
could just add two more examples, I think as Martina mentioned around it, I think one of the institutions was able to perform the auto generations of the case summaries, and they were able to reduce the analyst workload by 50% by adoption of the AI. I think there was another firm which we did, and they used AI smartly, as mentioned around on the deterministic model, was to look at the existing information and how they could increase their QA sampling or testing process actually over there. So it's not only in terms of development of the alerts portion of it, you can increase the efficiency portion also to ensure that how you could use AI for QA sampling to ensure that you are doing the validations which is required. I think there was another firm who was able to adopt, and the AI journey is not standalone. So it's not a binary journey that you go on AI journey and then you don't do the other journeys of cloud or API integrations. I think firms have been able to uh, do a clever mix of like the cloud enabling the real time processing and the AI adoptions. And combinations of this, they were able to process 10 million trades per day while reducing the infrastructure cost by 30% on it, actually. So I think there's a great, great benefit which is forthcoming or which is lying for us by the adoptions of AI.
fantastic. Well, some great use case examples
Yeah,
there.
can talk a lot.
Obviously, yep. a lot more to a lot more to come on that front, but fascinating to hear some of the progress that's been made today. And Martina, certainly looking forward to relevant product updates from Eventus on that front. As you sort of touched on, regulators have quite an appetite to embrace these new technologies, but if they're leading to results that the regulated firms cannot account for, that's where you run into issues. So certainly sounds like a strong use case for what you touched on. Looking forward to updates there. Um, Great. Let's move on to another major theme in the report, which is the challenge of unified surveillance across regions and across asset classes. And the report sort of identifies this tension between, making sure that you are managing your trade surveillance globally from the top down and that you have really good, consistent processes and a repeatable framework in place, but you need to account for specifics in particular asset classes, local jurisdictions, et cetera. And reconciling those two forces can be a real challenge. So, Vinod, talk a little bit about that tension between global and cross jurisdictional and what you're seeing when it comes to global and cross asset trade surveillance.
Absolutely. I think there's so many dynamics or dimensions associated with this topic. And I think that was one of the few, the first question which we were asking the respondents to really identify and open up around this regulatory mandate, which is global, but at the same time, they have to ensure that how does the asset class functionality works? How does the cross asset class functionality would work for their surveillance? I think in our discussions, we did highlight it to understand that what is the satisfaction level of the compliance, because the compliance is always to a specific regulations and a specific jurisdiction over here. So I think majority of them, there were 40% in neutral in US, more satisfaction level in the EMEA region, I would say. But I think in terms of the looking at the mandates, which is more local, even though the firm have global surveillance functions, that's more at the data governance level and the standardization of the process. I think the mandate for surveillance is always local to a specific regulatory mandate within that specific jurisdictions. So I think compliance to those is more critical. But at the same time, when the trades are being booked, they are booked globally. There's no method to say that I'm booking an equity trade only for a US regulation over here. I think those kind of trade doesn't, they're not the right trades, I would say. But I think looking at the cross asset class linkages across the functionality which has been booked, I think that's more critical. To give an example, I think the firms are looking at specific asset classes, not like a mix of all asset classes putting together, but there are specific pockets to look at equity derivatives transactions and the equity swap transactions along with the equity transactions over here to really identify that what's the nature of the surveillance activities which is happening at the desk on those. Another example was on the FX swaps and the fixed income trading which is happening over here. So if you have a fixed income trade which has a cross-border settlement, what's the nature of the FX settlement beyond it to ensure that you could do a cross-asset class surveillance within that. And I think the cross-asset class surveillance is the driver, I would say, to ensure that how do we ensure that the information which is being received is consistent in a global way so that the compliance is more of the downstream function to ensure that the same attributes can be used with multiple jurisdictions for the compliance portion of it.
Martina, curious to get your perspective on this.
Yeah. I mean, there are many challenges with cross-asset or cross-market surveillance. And, first is the data challenge, which I think Vinod was getting at, right? It is, you need to have a standardized and normalized data to input in your surveillance system to be able to even start looking at it across asset classes or markets. And, most of the firms do not have the same order management systems, which will add to the complexity. The account structure will also almost always differ between asset classes, even if it is in the same region or jurisdiction. And so those are just the two fundamental things that you just need to standardize in order to even attempt to have a sort of cross-asset surveillance. Um, the, Also, then to add to the complexity is the different regional jurisdictions and the different regional regulation. And so you not only do you have to make sure that you can conduct the cross-asset surveillance, but you also then have to have a system flexible enough to handle that, as well as being tailored to the specific regional jurisdiction as part of the same system. So it is complex. I do think, again, the really key here is to get the normalized and standardized data, and you have one surveillance system that are flexible enough to handle sort of multiple iterations of procedures, and also then to handle sort of account structure and utilize groups of accounts that you then can use for your cross-asset surveillance. But really, really coming down to the data aspect again, it's really key for being able to do this. But I think there's a huge opportunity, though, if you get this right, because not only, I mean, cross-asset and cross-market is a really big topic that firms want to solve for, because it's required to have that part as part of your surveillance program. But I also think if you get to a place where you have more of a unified and standardized data across your regional offices, you can actually start to utilize sort of the follow the sun approach and use your regional teams to cover global trading. And that's a huge benefit because, as we said, the 24/5, the global expansion of trading hours will put pressure on resources and how to staff your teams. So if you then can utilize your teams across your global footprint, then it will, really enhance your efficiencies. But again, it's then you are reliant on your trade surveillance to be the same and flexible to have, both aspect of regional and global rules. And then training, of course, and education and continuous education is also very important to keep up, so you know that your teams are able to handle sort of multiple jurisdictions. So a lot of challenges, but also a big opportunity if you get it right.
Absolutely. And you talked about team development and follow the sun and sort of calibrating your resources appropriately. The report does include some great insights on upskilling and professional development for the next chapter of trade surveillance, if you will. So encourage all of our readers to download the report, take a look at that. Some good insights there. So I know that we're getting to the end of the conversation, and the report near the end does conclude with some practical roadmap tips for what firms can do to prepare for this future of trade surveillance with higher data volumes, increasingly defined by AI use cases. Vinod, from your perspective, if you had to give firms one piece of advice for future-proofing their surveillance program, what comes to mind?
What comes to my mind, I think, is in terms of looking at the surveillance function. It is no longer about catching the bad actors only. It's about understanding the behavior, managing the risk, and staying ahead of the curve. It's not like you have to. There's a catching of the bad actor. That's one of the part of the surveillance function, but it's more of a risk management view to say that how the firms can be more competitive as and when they're expanding across regions, across asset class, or across new venues, new asset classes which is coming up, the emergence of the cryptocurrency trading which is coming up. I think the private markets, which are all converging within the public markets. I think there's more asset classes which is coming under the purview of the financial investments and trading. And I think that's where I think the surveillance behavior needs to change in terms of managing the risk. Look at more of a risk management function to ensure that how effectively the entire governance function is working to ensure that you could continue to do the trading activities over there. I think just to give an example, I think there were some firms when we were doing the interview at that point of time, the tariff announcement came across, and there was a huge market volatility which happened on those. I think the firms who had a decent amount of data governance, decent amount of infrastructure systems in place, they were able to navigate through those much quickly as compared to some of the firms who said that no, we were just struggling to get the data from the source systems into our surveillance. And sometimes there was a lag because it was a manual process. It would just delay the amount of alerts which needs to be managed during that volatility period over there. And I think firms need to ensure that they have the right balance of the risk management approach to ensure that they can navigate through these kind of volatility which can happen in the system. So,
Great. Well, that makes sense. Certainly a perspective informed by, as you said, many hours of conversations with the people who are on the front lines of all of this. So thank you for those thoughts, Vinod. Martina, in the spirit of looking ahead to the future of trade surveillance, from your perspective, what's the most exciting development that you see happening in this space right now?
Well, AI for sure. And we are very excited about our solution, Frank, that will give interactive and reliable and most of all, repeatable insights into the data at the analyst's fingertip. So that's it's a big thing. But other than AI, I do think focus on enhanced data analytics is also a big theme out there. Sort of use external input, news or market data to just enrich the alerts to get a better understanding upfront on sort of factors specific for the product or the asset class or the security that you are reviewing. And, I think, again, mentioned in the report, the talent that is most looked for in surveillance analysts nowadays has to do with data analytics capabilities, because so much of the surveillance is really about having the right data and understanding of the data. So data analytics, absolutely big part of the future. I also think dynamic thresholds or parameters are growing in demand. And this all plays into the field of how can you handle the noise, right? So dynamic thresholds will give you better calibration. It will give you more tailored specific procedures fit for your market and region. And as Vinod mentioned, it's also going to be help for market volatility or, just the difference when you're looking at a high liquid stock or a low liquid stock or a high priced versus a low priced stock. All of those are very hard when you have a static threshold. So just introducing that dynamic parameterization is really key in sort of getting a more dynamic and efficient way of handling your alerts. So I think these AI, dynamic parameters, data analytics, are really main themes that we hear about. And it all speaks to this efficiencies, right? You need to have a good efficient program and a tailored program for your jurisdiction asset classes. And I think all of that speaks to it. So these are items on our roadmap, and we are just continuing to work on getting that sort of efficient and relevant surveillance program out there to our clients.
That's great. And looking forward to in a few years, we talk about the next trade surveillance report, and what you just talked about has become table stakes, and we're focusing on the next wave of innovation. So all sounds great. Thank you both for a great discussion today. As we were going through it, but what came to mind for me is that, there's so many functions that are facing the modern enterprise, really, harnessing and making the most of data and data management, globalization, figuring out how to intelligently use AI to benefit your business. Trade surveillance is at the intersection of all of that. And when you throw sort of demand for more asset classes and just more diverse investor demands in general into the mix, it is a space with a lot of innovation happening, a lot of big challenges, but a lot to talk about as far as the progress that's being made towards solving those challenges. So the report does a fantastic job of recapping all of these things that are occurring in the trade surveillance space right now. If you'd like to download the report and learn more about the topics that we talked about today, you could head over to eventus.com, some other great resources on their website on trade surveillance and what they're doing to innovate in that space. You could also head over to datos-insights.com for a full menu of their latest research. And of course, you could head over to forefrontcomms.com for a full archive of At the Forefront episodes as well. So once again, this has been At the Forefront. Martina, Vinod, great conversation today. Thank you both again for taking the time.